Number 10. Bernie Madoff. The architect of history's largest Ponzi scheme. Bernard Lawrence Madoff ran what would become the largest Ponzi scheme in history, defrauding thousands of investors of approximately $65 billion over the course of nearly 2 decades. Madoff founded Bernard L. Madoff Investment Securities in 1960, and the firm became a highly respected Wall Street institution known for delivering remarkably consistent returns year after year, typically between 10 and 12% annually regardless of market conditions. This consistency should have raised red flags, but Madoff's reputation, his previous role as chairman of NASDAQ, and his philanthropic activities created an aura of legitimacy that attracted wealthy individuals, charitable foundations, retirement funds, and even sophisticated institutional investors. The fraud operated through a classic Ponzi structure where Madoff used money from new investors to pay returns to existing investors rather than generating actual profits through legitimate trading activities. Madoff's firm occupied 3 floors of the Lipstick Building in Manhattan, with the legitimate market-making business on the 18th and 19th floors, while the fraudulent investment advisory operation ran from the 17th floor, which employees called the hedge fund floor. For years, Madoff manufactured false trading records, account statements, and regulatory filings to maintain the illusion of a thriving investment operation. His brother Peter served as senior managing director and chief compliance officer, though the extent of his knowledge of the fraud remained disputed. The scheme began unraveling during the 2008 financial crisis when investors sought to withdraw approximately $7 billion as the market collapsed and credit froze. But Madoff's firm had only between $200 and $300 million in actual assets. On December 10, 2008, Madoff confessed to his sons Mark and Andrew that the investment advisory business was all just one big lie and basically a giant Ponzi scheme. His sons immediately contacted federal authorities, and FBI agents arrested Madoff at his Manhattan penthouse apartment the following morning. The criminal complaint charged him with securities fraud, and prosecutors eventually identified victims in more than 100 countries who lost their life savings, retirement funds, and charitable endowments. Among the victims were elderly individuals who lost everything they had saved for retirement, Holocaust survivor Elie Wiesel's foundation, which lost $15 million, and numerous charities that were forced to close their doors entirely. The human cost extended beyond financial loss as several victims committed suicide after learning their savings had vanished, including French aristocrat Thierry Magan de la Villehuchet, who took his own life in his Madison Avenue office just weeks after Madoff's arrest, and William Foxton, a British Army veteran who lost his entire pension and killed himself after leaving a note expressing his devastation. Madoff's family also suffered tremendously as both of his sons faced public scrutiny and legal investigations, with Mark Madoff hanging himself in his Manhattan apartment on the 2nd anniversary of his father's arrest, leaving behind a wife and young children. Madoff pleaded guilty on March 12, 2009, to 11 federal felonies including securities fraud, investment advisor fraud, mail fraud, wire fraud, money laundering, making false statements, perjury, making false filings with the SEC, and theft from an employee benefit plan. At his sentencing hearing in June 2009, Judge Denny Chin listened to victim impact statements describing financial devastation, shattered retirements, and ruined lives before imposing the maximum sentence of 150 years in federal prison, calling Madoff's crimes extraordinarily evil, and noting that the sentence should send a message. Madoff showed little emotion during the proceedings and offered an apology that many victims found inadequate and insincere. Federal authorities appointed Irving Picard as trustee to recover assets for victims, and over the following years, Picard filed hundreds of clawback lawsuits against individuals and institutions that had withdrawn more money from Madoff's firm than they invested, regardless of whether they knew about the fraud. These recovery efforts eventually returned more than $14 billion to victims, though many received only a fraction of what they believed they had in their accounts. Madoff's wife Ruth agreed to forfeit her claim to $80 million in assets and was left with just $2.5 million, while federal prosecutors seized the Madoff family's homes, boats, cars, and jewelry. Peter Madoff pleaded guilty to falsifying documents and lying to regulators, receiving a 10-year prison sentence. Madoff himself was incarcerated at the Federal Correctional Institution in Butner, North Carolina, where he reportedly told fellow inmates he believed his victims were greedy and should have known the returns were too good to be true. He died in prison on April 14, 2021, at age 82 from natural causes, having served less than 12 years of his sentence. The Madoff scandal exposed catastrophic failures in financial regulation as the Securities and Exchange Commission had received detailed warnings about Madoff's operation for years, most notably from financial analyst Harry Markopolos, who submitted evidence to the SEC in 1999, 2000, 2001, 2005, and 2007, explicitly stating that Madoff's returns were mathematically impossible and that the firm was operating a Ponzi scheme. The SEC conducted multiple examinations of Madoff's firm but failed to uncover the fraud due to a combination of inexperienced investigators, inadequate follow-up on red flags, and Madoff's ability to deceive regulators with his reputation and fabricated documents. The case led to significant reforms in financial regulation and investor protection, including enhanced SEC examination procedures, stricter custody requirements for client assets, and mandatory surprise audits for investment advisors. The Madoff fraud remains the definitive example of how unchecked greed, regulatory failure, and misplaced trust can combine to create a financial catastrophe that destroys thousands of lives and undermines faith in the entire financial system, with victims including not just wealthy investors who could afford the loss but ordinary people, retirees, charitable organizations, and foundations dedicated to education, healthcare, and helping those in need who lost everything they had worked decades to build. Number 9. The Enron Corporation collapse. Corporate fraud on a massive scale. Enron Corporation was once America's 7th largest company and a Wall Street darling praised for innovation in energy trading. But behind the impressive facade lay one of the most elaborate corporate frauds in American history that ultimately destroyed the company, wiped out billions in shareholder value, eliminated thousands of jobs, and devastated the retirement savings of employees who had invested their entire 401k accounts in Enron stock. Founded in 1985 through the merger of Houston Natural Gas and Internorth, Enron initially operated as a natural gas pipeline company but transformed during the 1990s under CEO Jeffrey Skilling and Chairman Kenneth Lay into an energy trading powerhouse that claimed to be revolutionizing how electricity and natural gas were bought and sold. The company's stock price soared from approximately $20 per share in the mid-1990s to a peak of $90.75 in August 2000, giving Enron a market capitalization of nearly $70 billion and making it one of the most valuable companies in America. Fortune magazine named Enron America's most innovative company for 6 consecutive years from 1996 through 2001, and business schools taught Enron strategies as examples of forward-thinking corporate management. However, the company was using fraudulent accounting practices to hide billions of dollars in debt and inflate profits, creating an illusion of success that enriched executives while setting up thousands of employees and investors for catastrophic losses. The fraud centered on Enron's use of mark-to-market accounting and special-purpose entities, which are technically legal financial tools but were manipulated by Enron to deceive investors and regulators. Under mark-to-market accounting, Enron would book projected profits from long-term energy contracts immediately rather than recognizing revenue as it actually came in, allowing the company to report huge profits from deals that might not generate actual cash for years or might fail entirely. When these projected profits failed to materialize, Enron would hide the losses by transferring them to special-purpose entities, which are off-balance sheet partnerships that allowed Enron to keep debt off its financial statements and maintain the appearance of a healthy balance sheet. Chief Financial Officer Andrew Fastow created hundreds of these partnerships with names like Chuco, LJM1, LJM2, and the Raptors, and he personally profited by more than $45 million from managing these entities while simultaneously working as Enron's CFO, creating an obvious conflict of interest that should have alarmed the board of directors and auditors. Arthur Andersen, one of the world's most prestigious accounting firms, served as Enron's auditor and signed off on financial statements that concealed the true extent of Enron's debt and inflated its profits, with Andersen partners earning substantial fees from both audit and consulting work for Enron, creating a financial incentive to maintain the relationship rather than challenge questionable accounting practices. As Enron's actual business performance deteriorated in 2000 and 2001, executives accelerated their fraud to maintain the stock price and continue receiving bonuses tied to company performance, while simultaneously selling their own Enron shares worth hundreds of millions of dollars even as they encouraged employees and outside investors to buy more stock. Kenneth Lay sold Enron stock worth over $70 million during 2000 and 2001, while repeatedly assuring employees and investors that the company was financially sound, and Jeffrey Skilling sold shares worth approximately $15 million before abruptly resigning as CEO in August 2001, citing personal reasons but later admitting he knew the company was in severe financial trouble. Enron employees had much of their retirement savings invested in Enron stock through the company's 401k plan, and during critical periods when the stock price was collapsing, Enron locked employees out of their accounts, claiming the lockdown was necessary for administrative changes to the 401k plan administrator, preventing employees from selling their shares as the stock price plummeted from $30 to less than $1. The fraud began unraveling when Enron Vice President Sharon Watkins sent an anonymous letter to Kenneth Lay in August 2001 warning that the company might implode in a wave of accounting scandals, and questioning the legitimacy of Enron's special-purpose entities. Though Lay took no meaningful action beyond having Enron's law firm Vinson & Elkins conduct a limited investigation that was designed to avoid discovering problems rather than genuinely examining Watkins' concerns. Wall Street Journal reporter Rebecca Smith and Fortune magazine writer Bethany McLean published articles questioning Enron's financial practices and noting that analysts could not explain how Enron actually made money, raising concerns that began eroding investor confidence. On October 16, 2001, Enron announced a $618 million loss for the third quarter and disclosed a $1.2 billion reduction in shareholder equity related to unwinding special-purpose entities, causing the stock price to drop significantly. The Securities and Exchange Commission opened an investigation into Enron's accounting practices on October 22, 2001, and as the investigation proceeded, Enron's credit rating was downgraded, triggering contractual obligations that required the company to immediately repay billions in debt that it did not have. On December 2, 2001, Enron filed for Chapter 11 bankruptcy protection, which was at that time the largest bankruptcy filing in American history with $63.4 billion in assets. The bankruptcy eliminated more than $74 billion in market capitalization that had existed at Enron's peak, wiped out approximately $2 billion in employee pension plans, and eliminated approximately 5,600 jobs as the company liquidated. Thousands of Enron employees who had invested heavily in company stock through their retirement accounts saw their life savings evaporate, with some workers losing hundreds of thousands of dollars that represented decades of contributions and earnings. Criminal investigations led to the indictment of multiple Enron executives, with the Justice Department creating an Enron task force to prosecute those responsible for the fraud. Andrew Fastow pleaded guilty to conspiracy and was sentenced to 6 years in federal prison after agreeing to cooperate with prosecutors and forfeit nearly $30 million. Jeffrey Skilling was convicted of 19 counts of conspiracy, fraud, false statements, and insider trading and originally received a sentence of 24 years and 4 months, though this was later reduced to 14 years, and he was released in 2019 after serving 12 years. Kenneth Lay was convicted on 10 counts of securities fraud and related charges in May 2006, but he died of a heart attack in July 2006 before sentencing, and under federal law, his conviction was vacated due to his death before the appeals process could be completed. Arthur Andersen was convicted of obstruction of justice for shredding Enron documents, resulting in the firm surrendering its accounting license and effectively ceasing operations, eliminating approximately 85,000 jobs worldwide at a firm that had been one of the Big Five accounting firms. The Enron scandal led to sweeping legislative reforms aimed at preventing similar corporate frauds, most notably the Sarbanes-Oxley Act of 2002, which established stricter accounting standards, enhanced penalties for corporate fraud, created new protections for whistleblowers, required CEOs and CFOs to personally certify the accuracy of financial statements, and established the Public Company Accounting Oversight Board to regulate accounting firms. The case remains a cautionary tale about the dangers of corporate greed, conflicts of interest in financial auditing, the importance of regulatory oversight, and the devastating human cost when executives prioritize personal enrichment and stock prices over honest business practices and fiduciary duties to employees and shareholders. Number 8. Allen Stanford's $8 billion Ponzi scheme. Robert Allen Stanford built a financial empire based in the Caribbean that defrauded investors of approximately $7 billion through a massive Ponzi scheme that operated for nearly 2 decades before collapsing in 2009, leaving thousands of victims across more than 100 countries with devastating losses. Stanford, a Texas businessman who styled himself as Sir Alan Stanford, after purchasing a knighthood from the government of Antigua and Barbuda, operated Stanford International Bank, which was based in Antigua and claimed to manage assets worth more than $8 billion for approximately 30,000 clients worldwide. The bank attracted investors by promising higher returns than traditional certificates of deposit, typically offering interest rates 2 to 3 percentage points higher than comparable products from established U.S. banks, with rates ranging from 7 to 11% depending on the term length. Stanford's marketing emphasized the safety and stability of the investments, claiming the funds were invested in a diversified portfolio of easily liquidated assets managed by a team of expert analysts who consistently outperformed the market through superior investment strategies. Sales agents working for Stanford Financial Group, which was the U.S.-based network of financial advisors who sold Stanford International Bank certificates of deposit, earned substantial commissions for bringing in new investors and were trained to emphasize the safety of the investments and Stanford's reputation as a successful businessman and philanthropist. The fraud operated similarly to Madoff's Ponzi scheme, using money from new investors to pay returns to existing investors rather than generating legitimate investment profits. While Stanford and his associates siphoned off billions for personal use, including a lavish lifestyle of private jets, yachts, mansions, and a professional cricket tournament that Stanford sponsored in the Caribbean. Laura Pendergast Holt served as chief investment officer of Stanford Financial Group and later testified that she had no idea where the bank's money was actually invested, admitting under questioning from regulators that the investment portfolio described to clients was largely fictional. James Davis, Stanford's college roommate and the bank's chief financial officer, managed the internal accounting that concealed the fraud by creating false financial statements and fictitious investment records. The certificates of deposit were sold primarily to individual investors, including many retirees who invested their life savings based on assurances from Stanford advisors that the investments were safe, conservative, and backed by liquid assets that could be accessed if needed. Stanford cultivated an image of wealth and success through conspicuous displays including ownership of multiple Caribbean islands, a fleet of jets, sponsorship of sporting events, and generous donations to politicians in both the United States and Antigua. The scheme's scale and geographic reach meant victims included Americans who invested through Stanford's network of U.S. financial advisors, Latin American investors who trusted Stanford's regional presence and Spanish-language marketing, European investors attracted by the bank's purported sophistication, and Caribbean nationals who viewed Stanford as a major employer and economic contributor to the region. The Securities and Exchange Commission had examined Stanford's operations multiple times over the years, but failed to stop the fraud despite obvious red flags, including the impossibility of consistently generating the reported returns in the claimed portfolio, the lack of transparency about actual investments, the concentration of assets in a bank located in a jurisdiction with minimal regulatory oversight, and the fact that Stanford International Bank's financial statements were audited by a tiny accounting firm in Antigua rather than a recognized international auditor. Whistleblowers and financial analysts had raised concerns about Stanford's operations for years, with some noting that the reported returns were suspiciously consistent and that Stanford's explanations of his investment strategy were vague and implausible. The scheme collapsed in February 2009 when the SEC filed civil fraud charges against Stanford, Stanford International Bank, and several associates, freezing assets and effectively shutting down operations. Stanford initially fled, and authorities located him in Virginia, where they served him with legal papers, after which he spent time in a hospital claiming amnesia and inability to assist in his own defense, though prosecutors argued he was malingering to avoid prosecution. The FBI arrested Stanford in June 2009 on criminal charges including conspiracy, fraud, and obstruction of justice. As Stanford's operations ceased, thousands of investors learned that their certificates of deposit were worthless and that the billions of dollars they believed were safely invested had vanished, with many victims losing their entire retirement savings, college funds for children, and proceeds from selling homes or businesses. Unlike Madoff's victims, Stanford's victims have recovered very little of their losses because investigators found minimal assets remaining after years of Stanford using client money to fund his lifestyle and business ventures, with court-appointed receivers recovering less than $500 million from an estimated $7 billion in investor losses. The criminal trial, which began in January 2012 after delays related to Stanford's claims of health issues and incompetence to stand trial, featured testimony from James Davis, who pleaded guilty and cooperated with prosecutors by explaining how he and Stanford fabricated financial statements and misled investors for decades. The jury heard evidence that Stanford used approximately $2 billion of investor money to fund his cricket tournaments, real estate developments, and personal expenses while telling clients their money was invested in liquid, safe securities. On March 6, 2012, after 4 days of deliberation, the jury convicted Stanford on 13 of 14 criminal counts, including conspiracy to commit wire and mail fraud, wire fraud, mail fraud, conspiracy to obstruct an SEC investigation, and obstruction of an SEC investigation. At sentencing in June 2012, Judge David Hittner heard emotional testimony from victims who described financial ruin, stress-related health problems, broken marriages, and shattered dreams for retirement, before imposing a sentence of 110 years in federal prison and ordering Stanford to forfeit more than $5.9 billion, though prosecutors acknowledged that recovering significant funds for victims was unlikely. Stanford, who was then 62 years old, maintained his innocence and claimed he was a legitimate businessman who had been destroyed by a conspiracy, showing no remorse for the thousands of victims whose lives he had devastated. He is currently incarcerated at the Federal Correctional Institution in Coleman, Florida, where he continues to assert his innocence despite overwhelming evidence of fraud and the testimony of former associates who admitted participating in the scheme under his direction. The Stanford case highlighted the vulnerability of international investors to fraud schemes based in offshore jurisdictions with weak regulatory oversight, the failure of regulatory agencies to act on clear warning signs, and the particular cruelty of Ponzi schemes that target retirees and others who cannot afford to lose their invested capital. Many of Stanford's victims were elderly individuals who invested savings accumulated over lifetimes of work, expecting to live on the interest payments, only to discover in their 70s and 80s that their money was gone and they faced the prospect of poverty after years of believing they were financially secure. Some victims committed suicide after learning of their losses, while others lost homes, were forced to work far past retirement age, or became dependent on family members or government assistance. The case also exposed the conflicts of interest in financial advising when salespeople earn large commissions for steering clients into products without adequately investigating whether the promised returns are legitimate or whether the investment sponsor has the assets and strategies necessary to deliver on its promises. Number 7. The savings and loan crisis fraud that cost taxpayers billions. The savings and loan crisis of the 1980s and early 1990s represented one of the largest financial disasters in American history, involving the failure of approximately 1,000 savings and loan institutions, costing taxpayers approximately $160 billion in bailout funds, and featuring widespread fraud, mismanagement, and regulatory failure that destroyed the life savings of countless depositors and undermined confidence in the American banking system. Savings and loan associations, also known as thrifts, were financial institutions originally created to help ordinary Americans buy homes by accepting deposits and using those funds to make residential mortgage loans. The crisis had roots in the 1970s when rising inflation and interest rates created financial stress for SNLs that held long-term mortgages at fixed low interest rates while being forced to pay increasingly higher rates to attract deposits, creating a situation where many institutions were losing money on the spread between what they paid depositors and what they earned on mortgages. Congress responded in 1980 and 1982 with deregulation that allowed SNLs to make riskier investments, including commercial real estate loans, junk bonds, and direct investments in land development, while simultaneously increasing federal deposit insurance from $40,000 to $100,000 per account, creating a situation where SNL operators could take huge risks with depositors' money knowing that losses would ultimately be covered by taxpayers. This combination of expanded investment authority, inadequate regulatory oversight, and the moral hazard created by deposit insurance produced an environment where fraud and reckless speculation flourished at hundreds of institutions across the country. Charles Keating became the most notorious figure in the crisis through his operation of Lincoln Savings and Loan, which he purchased in 1984 and transformed from a conservative home mortgage lender into a vehicle for risky real estate speculation and direct investments that ultimately failed, costing taxpayers approximately $3 billion when the institution collapsed. Keating and his associates engaged in a variety of fraudulent practices, including using Lincoln's deposits to purchase junk bonds from companies Keating controlled, selling worthless real estate between Keating-owned entities at inflated prices to create the appearance of profits, paying enormous salaries and bonuses to Keating family members, and most notoriously, having Lincoln branch employees pressure elderly depositors to transfer their federally insured deposits into uninsured high-risk bonds issued by Lincoln's parent company American Continental Corporation, misleading investors into believing these bonds were as safe as their insured deposits. When American Continental Corporation filed for bankruptcy in April 1989, approximately 23,000 bondholders, many of them elderly retirees who had been told the bonds were safe, lost approximately $285 million. Federal regulators had identified problems at Lincoln as early as 1986, but Keating wielded political influence through massive campaign contributions to politicians, including 5 U.S. senators who became known as the Keating Five, and intervened with regulators on his behalf, delaying the closure of Lincoln for several years, during which losses mounted and more investors were defrauded. The Keating Five, consisting of Senators Alan Cranston, Dennis DeConcini, John Glenn, John McCain, and Donald Regal, met with federal banking regulators in 1987 to question why the examination of Lincoln was taking so long and whether regulators were being overzealous, creating pressure that contributed to delays in taking action against Lincoln even as evidence of fraud accumulated. Beyond Keating's Lincoln savings, hundreds of other SNLs engaged in fraud or reckless speculation that contributed to the crisis, with some institutions being looted by their own executives who made loans to themselves and associates with no intention of repayment, purchased luxury items with depositors' money, and paid themselves exorbitant salaries and bonuses while their institutions became insolvent. Vernon Savings and Loan in Dallas became known for lavish spending by executives who used depositor funds to purchase expensive cars, a fleet of airplanes, beach houses, and a $6 million Florida mansion, while making billions in risky loans that defaulted, ultimately costing taxpayers approximately $1.3 billion when the institution failed. Don Dixon, who controlled Vernon Savings, exemplified the excess of the era by using the SNL's money to fund a European vacation that cost $96,000, purchasing a yacht, maintaining multiple lavish homes, and making loans to associates for questionable real estate projects, all while regulators failed to stop the hemorrhaging of depositor funds until the institution was hopelessly insolvent. The crisis revealed catastrophic failures in federal regulation as agencies responsible for supervising SNLs, including the Federal Home Loan Bank Board and its examination arm, the Federal Savings and Loan Insurance Corporation, were understaffed, underfunded, and often staffed by examiners with insufficient training to understand complex financial transactions or recognize fraud. The Reagan administration's emphasis on deregulation and reducing government oversight contributed to an environment where regulators were reluctant to aggressively pursue enforcement actions against troubled institutions, and political appointees sometimes overruled career examiners who identified problems. By the late 1980s, it became clear that hundreds of SNLs were insolvent and that the Federal Savings and Loan Insurance Corporation, which insured SNL deposits, lacked sufficient funds to cover depositor losses, requiring a massive taxpayer bailout. Congress passed the Financial Institutions Reform, Recovery, and Enforcement Act in 1989, which abolished the existing regulatory structure, created new agencies including the Office of Thrift Supervision and the Resolution Trust Corporation, increased regulatory capital requirements, restricted the types of investments SNLs could make, and authorized taxpayer funds to cover depositor losses and wind down failed institutions. The Resolution Trust Corporation took control of failed SNLs, liquidated their assets, and paid off depositors, ultimately resolving approximately 750 institutions with assets totaling approximately $400 billion. The Justice Department created special task forces to prosecute SNL fraud, and over the following years, more than 1,000 individuals were convicted of crimes related to the crisis, with sentences ranging from probation to long prison terms. Charles Keating was convicted in both state and federal courts on multiple counts of fraud, racketeering, and conspiracy, receiving sentences totaling 12.5 years, though his convictions were later overturned on technical grounds and he eventually pleaded guilty to lesser charges, serving 4.5 years in prison before being released in 1999. The crisis had devastating effects on communities across the country, particularly in states like Texas, Arizona, and California, where real estate speculation fueled by S&L lending had created bubbles that burst when the institutions failed, leading to thousands of foreclosures, abandoned development projects, and economic downturns that cost tens of thousands of jobs. Individual depositors generally did not lose money because of federal deposit insurance, but taxpayers bore the enormous cost of the bailout, estimated at approximately $160 billion including interest, with the debt not fully paid off until the 2010s. The S&L crisis demonstrated how deregulation without adequate oversight can create opportunities for fraud and reckless risk-taking, how political influence can undermine regulatory enforcement, how deposit insurance creates moral hazard when institutions can take risks knowing taxpayers will cover losses, and how the consequences of financial sector failures extend far beyond the institutions themselves to affect entire communities and the broader economy. The lessons of the S&L crisis were largely forgotten during the lead-up to the 2008 financial crisis, which featured many similar dynamics including deregulation, inadequate oversight, risky lending practices, and ultimately massive government bailouts, suggesting that the fundamental problems of financial sector governance and regulation remain unresolved despite the enormous costs of past failures. Number 6. The LIBOR scandal. Manipulation of a fundamental interest rate. The London Interbank Offered Rate, known as LIBOR, served as a fundamental benchmark interest rate that affected trillions of dollars in financial contracts worldwide, including mortgages, student loans, credit cards, and complex financial derivatives. But investigations beginning in 2008 revealed that major banks had been manipulating this rate for years to benefit their trading positions and create false impressions of their financial health, undermining the integrity of global financial markets and costing consumers, investors, and counterparties billions of dollars. LIBOR represented the average interest rate at which major banks believed they could borrow from each other in the London wholesale money market, with rates calculated daily for multiple currencies and borrowing periods based on submissions from a panel of banks that reported the rates at which they believed they could borrow. The British Bankers Association, which administered LIBOR until regulatory reforms transferred oversight to ICE Benchmark Administration, collected rate submissions from panel banks each morning, eliminated the highest and lowest quartiles, and averaged the remaining submissions to produce the published LIBOR rate for each currency and term. This process relied on the honesty of submitting banks, creating an obvious vulnerability to manipulation if banks chose to report rates that benefited their financial interests rather than genuinely reflecting market conditions. The manipulation took two primary forms: traders at major banks requesting that colleagues who submitted LIBOR rates adjust their submissions to benefit the bank's trading positions in derivatives and other instruments tied to LIBOR, and banks submitting artificially low rates during the financial crisis to create the false impression that they could borrow cheaply and were therefore financially healthy when in reality they faced funding difficulties. Investigations by regulators in multiple countries, including the U.S. Commodity Futures Trading Commission, the U.S. Department of Justice, the U.K. Financial Services Authority, and authorities in the European Union, Japan, and Switzerland, uncovered extensive evidence of manipulation spanning many years and involving some of the world's largest and most prestigious financial institutions. Barclays became the first bank to settle with regulators in June 2012, paying approximately $450 million in fines to U.S. and U.K. authorities and admitting that its traders had manipulated LIBOR and Euribor, the European equivalent, between 2005 and 2009. Internal communications revealed traders making explicit requests for favorable rate submissions, with one email stating, "I need you to keep it as low as possible," and another reading, "Dude, I owe you big time. I'm opening a bottle of Bollinger." The revelation that Barclays had manipulated LIBOR triggered a political and public outcry in the UK, forcing the resignation of Chief Executive Bob Diamond and Chairman Marcus Agius, though no senior executives faced criminal charges despite clear evidence that manipulation occurred under their leadership. Following Barclays' settlement, investigations expanded to other major banks, and over the following years, authorities extracted billions in fines from institutions including UBS, which paid approximately $1.5 billion, the Royal Bank of Scotland, which paid approximately $612 million, Rabobank, which paid approximately $1 billion, Deutsche Bank, which paid approximately $2.5 billion, and numerous other institutions including JP Morgan Chase, Citigroup, Bank of America, and HSBC. The fines totaled approximately $9 billion across all settling banks, representing one of the largest regulatory enforcement actions in financial history, though critics noted that these fines represented only a small fraction of the profits these banks earned and amounted to a cost of doing business rather than a deterrent to future misconduct. The human cost of LIBOR manipulation was difficult to quantify precisely but potentially enormous, as LIBOR affected approximately $350 trillion in financial contracts worldwide, meaning even small manipulations could transfer billions from borrowers to lenders or vice versa depending on the direction of the manipulation. Homeowners with LIBOR-linked adjustable-rate mortgages potentially paid higher interest costs if manipulation pushed rates up, while pension funds and investors in LIBOR-linked securities potentially received lower returns if manipulation pushed rates down. Cities, school districts, and government entities that entered into complex interest rate swaps tied to LIBOR potentially lost billions if the manipulation caused them to pay higher rates or receive lower payments than they should have under honest rate setting. The manipulation undermined confidence in financial markets more broadly by demonstrating that even supposedly objective, independently administered benchmark rates were subject to manipulation by the institutions those rates were meant to monitor. Criminal prosecutions of individual traders and submitters provided some accountability, with Tom Hayes, a former UBS and Citigroup trader, receiving a sentence of 14 years in UK prison for conspiracy to defraud in the first criminal trial related to LIBOR manipulation, though his sentence was later reduced to 11 years and he was released after serving approximately 5.5 years. Hayes maintained that his supervisors knew about and encouraged rate manipulation, and that he was being made a scapegoat for practices that were widespread across the industry and known to bank management. 6 other UK-based traders were convicted in various trials and received sentences ranging from 2 to 6.5 years, while several traders in the United States pleaded guilty to conspiracy and fraud charges, received sentences ranging from probation to 2 years, and agreed to cooperate with prosecutors in continuing investigations. The fact that relatively few individuals faced criminal prosecution despite overwhelming evidence of systematic manipulation at multiple institutions highlighted the persistent problem of accountability in financial crime, where institutions pay fines funded by shareholders while the executives and traders who actually committed misconduct often escape significant consequences. The scandal led to fundamental reforms in how benchmark interest rates are calculated and governed, with LIBOR administration transferring from the British Bankers Association to ICE benchmark administration under regulatory oversight, new rules requiring rate submissions to be based on actual transactions rather than estimates where possible, enhanced surveillance and audit requirements, and ultimately the decision to phase out LIBOR entirely by the end of 2021 in favor of alternative reference rates based on actual transaction data rather than bank estimates. The transition away from LIBOR affected hundreds of trillions of dollars in existing contracts that referenced the rate, requiring massive coordination among market participants, regulators, and legal experts to either modify contracts to reference alternative rates or allow them to expire naturally. The LIBOR scandal demonstrated how the global financial system relies on trust and honest reporting of information, how conflicts of interest can lead to widespread misconduct when oversight is inadequate, how major institutions will prioritize profits over integrity if they believe they can manipulate systems without consequences, and how difficult it is to hold individuals accountable for financial crimes that occur within large organizations where responsibility is diffused and senior. Executives can claim ignorance of misconduct by subordinates. The case remains a cautionary tale about the importance of robust oversight, the need for benchmark rates to be based on objective transaction data rather than subjective estimates, and the corrosive effect of financial sector misconduct on public trust and market integrity. Number 5. The Wirecard scandal. Europe's Enron Moment. Wirecard AG was a German payment processing company that grew rapidly during the 2010s to become one of the 30 most valuable publicly traded companies in Germany, joining the prestigious DAX index in 2018. But the company's success was built on fraudulent accounting that inflated revenues and assets by billions of euros, culminating in the revelation in June 2020 that approximately 1.9 billion euros supposedly held in trustee accounts in the Philippines did not exist, triggering the company's collapse, criminal investigations of executives, and questions about regulatory and audit failures that allowed the fraud to continue for years. Wirecard operated in the payment processing industry, providing services that allowed businesses to accept credit card and electronic payments, and the company positioned itself as an innovative technology firm disrupting traditional financial services. Under Chief Executive Markus Braun, who joined the company in 2002 and served as CEO from 2005 until his arrest in June 2020. Wirecard pursued aggressive expansion through acquisitions and claimed rapid revenue growth that impressed investors and drove the stock price from single-digit euros in the early 2010s to a peak of over 190 euros in September 2018, giving the company a market capitalization of approximately 24 billion euros. The company's reported success seemed to validate Germany's ability to produce technology champions that could compete with Silicon Valley firms, and Wirecard received positive media coverage and government support, with German Chancellor Angela Merkel personally promoting the company during trade missions to China. However, journalists, short sellers, and whistleblowers raised questions about Wirecard's accounting for years before the fraud finally became undeniable, and the German financial regulator BaFin and Wirecard's auditor EY failed to adequately investigate these concerns, allowing the fraud to continue and expand. The Financial Times published a series of investigative articles beginning in 2015 raising questions about Wirecard's accounting practices, its relationships with third-party partners in Asia, and unusual patterns in its reported revenues, but Wirecard and its supporters dismissed these reports as the work of short sellers attempting to manipulate the stock price. In an extraordinary move that highlighted regulatory capture, BaFin, the German financial regulator, filed a criminal complaint against Financial Times journalists and imposed a ban on short-selling Wirecard shares in 2019, attempting to protect the company rather than investigate whether the journalistic allegations had merit. The fraud centered on fabricated revenues from third-party acquiring partnerships in Asia and the Middle East, where Wirecard claimed to process payments for online gambling, adult entertainment, and other merchants through local partners. In reality, much of this business was fictional, with Wirecard executives creating false contracts, bank statements, and transaction records to convince auditors that billions in revenues and assets existed when they did not. Jan Marsalek, Wirecard's chief operating officer and Braun's closest lieutenant, orchestrated much of the fraud with assistance from associates in the Philippines, Singapore, and Dubai who created forged documents and made misleading statements to auditors. Christopher Bauer, a Wirecard executive in Dubai, later testified that he helped create fraudulent documents at Marsalek's direction and that the scale of fabrication was enormous, involving teams of people generating false accounting records. In June 2019, the Financial Times published internal Wirecard documents showing fraudulent accounting at subsidiaries in Dubai and Dublin, leading to increased scrutiny from regulators and investors, but EY, which had audited Wirecard's financial statements for years and consistently given unqualified opinions, claimed it needed more time to verify the existence of cash balances that Wirecard claimed were held in trustee accounts. EY hired a forensic accounting firm to examine Wirecard's Asian operations and received confirmation letters supposedly from banks in the Philippines confirming that approximately 1.9 billion euros were held in trustee accounts on Wirecard's behalf. But these letters were forgeries. On June 18, 2020, EY announced it could not confirm the existence of the cash balances and refused to sign off on Wirecard's 2019 financial statements, causing Wirecard's stock price to collapse. Wirecard then admitted that the 1.9 billion euros in trustee accounts probably did not exist, having been fabricated to inflate the company's balance sheet. Markus Braun resigned as CEO on June 19 and was arrested on June 23 on suspicion of fraud and market manipulation, while Jan Marsalek was fired on June 22 and fled Germany, becoming an international fugitive believed to be hiding in Russia with possible assistance from Russian intelligence services. Wirecard filed for insolvency on June 25, 2020, eliminating thousands of jobs and wiping out billions in shareholder value, with the stock price falling from over 100 euros just days earlier to less than 2 euros. German prosecutors charged Braun with fraud, breach of trust, and market manipulation, alleging he was responsible for inflating Wirecard's revenues and balance sheet by billions of euros and misleading investors, customers, and regulators about the company's true financial condition. Braun's trial began in December 2022 in Munich, with prosecutors presenting evidence that Braun knew about fraudulent accounting at least as early as 2015 and actively participated in the scheme by signing false financial statements and misleading auditors. Braun maintained his innocence, claiming he was deceived by Marsalek and other associates and portraying himself as a victim of fraud rather than a perpetrator, despite his position as CEO and his oversight of the financial reporting process. In addition to Braun, prosecutors charged several other former Wirecard executives and associates with fraud-related offenses, including Oliver Bellenhaus, the former head of Wirecard's Dubai subsidiary, who pleaded guilty and agreed to testify against other defendants in exchange for a reduced sentence. The Wirecard scandal exposed significant failures in Germany's financial regulatory system, as BaFin failed to investigate journalistic allegations of fraud, actively attacked the journalists who exposed problems, and demonstrated greater concern with protecting Germany's reputation for producing technology champions than with ensuring accurate financial reporting and investor protection. EY faced intense criticism for failing to detect the fraud despite auditing Wirecard for more than a decade and collecting millions in audit fees, with critics noting that the supposedly missing €1.9 billion represented a significant portion of Wirecard's total assets and should have been subject to rigorous verification procedures that would have revealed the fabrication. EY paid €90 million to settle a lawsuit by Wirecard's insolvency administrator but admitted no wrongdoing, while facing ongoing investigations by German authorities into whether its auditors met professional standards. The German government ordered reviews of BaFin and the financial auditing industry, leading to some reforms including additional oversight of auditors and changes to how financial regulators handle complaints about possible corporate fraud. Wirecard investors, including major asset managers and pension funds, lost billions as the stock became worthless, with many questioning how such a large fraud could occur at a prominent publicly traded company in a developed country with supposedly rigorous financial oversight. The scandal damaged Germany's reputation as a well-regulated financial center and raised questions about whether German authorities were too credulous toward domestic companies they viewed as national champions. Jan Marsalek remained a fugitive as of 2024, with German authorities issuing an international arrest warrant and speculating he was living in Russia under the protection of intelligence services he allegedly worked with during his time at Wirecard. The case demonstrated that major financial frauds are not limited to emerging markets or less regulated jurisdictions, but can occur in advanced economies when auditors fail to maintain professional skepticism. Regulators prioritize protecting corporate reputations over investor protection, and journalists who uncover fraud face retaliation rather than gratitude for exposing problems before they become catastrophic. Number 4. The 1MDB scandal looting a nation's wealth. 1 Malaysia Development Berhad, known as 1MDB, was a Malaysian sovereign wealth fund created in 2009 by then Prime Minister Najib Razak with the stated purpose of promoting economic development through strategic investments, but the fund instead became the vehicle for one of the largest kleptocracy schemes in history, as billions of dollars were systematically looted by Najib, Malaysian financier Jho Low, and their associates. Through a complex web of fraudulent bond offerings, shell companies, and international money laundering, with the stolen funds used to purchase luxury real estate, fine art, jewelry, a superyacht, fund the production of Hollywood films including The Wolf of Wall Street, and make lavish gifts to celebrities and models. The scheme involved approximately $4.5 billion stolen from 1MDB through various transactions between 2009 and 2015, with the money flowing through bank accounts and shell companies in Singapore, Switzerland, Luxembourg, the British Virgin Islands, and the United States, disguised as legitimate investment transactions, joint venture payments, and strategic partnership fees. Jho Low, whose full name was Low Take Jho, was a Malaysian businessman with no official role in 1MDB but who orchestrated much of the fraud in partnership with Najib Razak, using his access to the Prime Minister and the Malaysian government to structure deals that allowed massive sums to be diverted from the sovereign wealth fund into accounts controlled by Low and his associates. The fraud began shortly after 1MDB's creation when the fund raised approximately $1 billion through bonds in 2009, with hundreds of millions immediately diverted to accounts controlled by Low and used for personal expenses including purchasing luxury real estate in New York and Los Angeles. In 2012 and 2013, 1MDB raised approximately $6.5 billion through bond offerings arranged by Goldman Sachs, with approximately $2.7 billion diverted through fraudulent transactions involving fake Abu Dhabi sovereign wealth fund Auber Investments, which Low and his associates created to appear as a legitimate joint venture partner when in reality the money flowed to shell companies and ultimately to personal accounts. Goldman Sachs earned approximately $600 million in fees for arranging these bond offerings, which was far above market rates and should have raised questions about why 1MDB was willing to pay such excessive fees. but Goldman bankers involved in the transactions prioritized the enormous fees and commission income over conducting adequate due diligence on where the bond proceeds were actually going. Tim Leissner, a senior Goldman Sachs banker in Southeast Asia, pleaded guilty in 2018 to conspiring to launder money and violate the Foreign Corrupt Practices Act, admitting he helped 1MDB raise billions through fraudulent bond offerings, paid hundreds of millions in bribes to Malaysian and Abu Dhabi officials to facilitate the scheme, and personally received approximately $60 million in kickbacks. Roger Ng, another Goldman Sachs banker who worked with Leissner on 1MDB transactions, was convicted in 2022 of bribery and money laundering charges and sentenced to 10 years in federal prison, with prosecutors presenting evidence that he received approximately $35 million in kickbacks and helped launder stolen 1MDB funds through shell companies and bank accounts. The stolen money funded an extravagant lifestyle for Jho Low and Najib Razak that attracted attention from law enforcement agencies around the world as the scale of purchases and spending seemed impossible to explain through legitimate income sources. Low purchased a superyacht called the Equanimity for approximately $250 million, multiple luxury properties including a bombardier jet for $35 million, penthouses in Manhattan worth over $30 million, and a mansion in Beverly Hills for approximately $39 million. He spent hundreds of millions on gambling in Las Vegas casinos, gave expensive jewelry worth millions to supermodels including Miranda Kerr, and funded lavish parties in Las Vegas, Los Angeles, and New York where he presented himself as a wealthy Malaysian investor. Perhaps most audaciously, Low helped finance the Hollywood film The Wolf of Wall Street, which ironically told the story of Jordan Belfort's financial fraud, using approximately $100 million in stolen 1MDB money to fund the production through Red Granite Pictures, a film company created by Najib Razak's stepson Riza Aziz. The film production provided Low with access to Hollywood celebrities and opportunities to burnish his image as a legitimate businessman and entertainment industry player. Najib Razak received approximately $680 million from 1MDB, related accounts that was deposited directly into his personal bank accounts in Malaysia, with the transfer structured to appear as donations from Saudi royalty when in reality the money was stolen from the Malaysian Sovereign Wealth Fund. Najib used these funds for political purposes including funding his political party's campaigns and making payments to political allies, as well as for personal expenses including expensive jewelry for his wife Rasma Mansur, who became notorious for her extravagant lifestyle and collection of luxury handbags and jewelry. The fraud began unraveling in 2015 when journalists at the Wall Street Journal and Sarawak Report published investigations revealing the flow of 1MDB money into Najib's personal accounts and questioning the fund's various transactions and partnerships. The revelations triggered political upheaval in Malaysia, with opposition politicians calling for Najib's resignation and investigations into 1MDB. But Najib initially survived by using his control of law enforcement and regulatory agencies to suppress domestic investigations, firing the Attorney General who was investigating 1MDB and replacing him with a loyalist who cleared Najib of wrongdoing. However, authorities in the United States, Switzerland, Singapore, and other countries launched investigations and began seizing assets purchased with stolen 1MDB money, with the U.S. Department of Justice filing civil forfeiture actions seeking to recover over $1.7 billion in assets including the superyacht, luxury real estate, fine artworks by Monet and Van Gogh, and jewelry. In Malaysia, public anger over the 1MDB scandal contributed to Najib's shocking defeat in the 2018 elections, marking the first time the ruling coalition that had governed Malaysia since independence lost power. The new government led by former Prime Minister Mahathir Mohamad reopened investigations into 1MDB and charged Najib with multiple counts of corruption, criminal breach of trust, money laundering, and abuse of power. Najib's trial began in 2019 and featured testimony from dozens of witnesses and documentary evidence showing the flow of money from 1MDB to Najib's accounts and the lavish spending that followed. On July 28, 2020, the High Court in Kuala Lumpur convicted Najib on 7 charges related to the transfer of approximately $10 million from SRC International, a 1MDB subsidiary, into his personal accounts, sentencing him to 12 years in prison and a fine of nearly $50 million. Najib appealed the conviction, remaining free on bail while the appeals process continued, but Malaysia's Court of Appeal unanimously upheld the conviction in December 2021, and the Federal Court, Malaysia's highest court, unanimously upheld the conviction and sentence in August 2022. sending Najib to prison to begin serving his 12-year sentence. Najib continues to face additional criminal trials on other charges related to 1MDB, with potential sentences totaling decades in prison if convicted on all counts. Rasma Mansur was separately convicted of corruption related to a solar panel project and sentenced to 10 years in prison, though she also appealed and remained free on bail as of 2024. Jho Low fled Malaysia and became an international fugitive, with authorities believing he was hiding in China or Macau, beyond the reach of countries seeking his arrest. The U.S. Justice Department charged Low with money laundering and conspiracy in 2018, with prosecutors alleging he was the mastermind of the 1MDB fraud and personally benefited by more than $1 billion. Goldman Sachs reached settlements totaling approximately $5 billion with authorities in the United States, Malaysia, and other countries for its role in the 1MDB scandal, with the bank admitting that a subsidiary violated anti-bribery laws and acknowledging that certain former employees participated in the fraud. The 1MDB scandal demonstrated how sovereign wealth funds intended to benefit national development can be captured by corrupt leaders and transformed into vehicles for personal enrichment, how international banks and financial institutions can facilitate massive fraud when profit incentives override compliance and due diligence obligations, how stolen money can be laundered through the global financial system and invested in assets across multiple jurisdictions, making recovery difficult, and how corruption at the highest levels of government can persist for years before public exposure and accountability. The case also highlighted the importance of independent journalism in exposing corruption, as reporters at the Wall Street Journal and Sarawak Report faced legal threats and intimidation but continued investigating and publishing despite efforts by Najib's government to suppress the story. For the people of Malaysia, the 1MDB scandal represented a massive theft of public resources that should have funded development projects, infrastructure, and programs benefiting ordinary citizens, but instead enriched corrupt elites and required the government to assume billions in debt that Malaysian taxpayers will be repaying for decades. Number 3. The Theranos fraud. Silicon Valley's billion-dollar blood testing lie. Theranos was a Silicon Valley health technology company founded in 2003 by Elizabeth Holmes, who claimed to have developed revolutionary blood testing technology that could perform hundreds of diagnostic tests using just a few drops of blood from a finger prick rather than traditional venous blood draws. But investigations beginning in 2015 revealed that the technology did not work as claimed, and that the company had been deceiving investors, business partners, patients, and regulators for years about its capabilities, leading to criminal fraud charges against Holmes and the company's president Ramesh Sunny Balwani. Holmes founded Theranos at age 19 after dropping out of Stanford University, and she cultivated an image as the next Steve Jobs, wearing black turtlenecks and speaking in an unusually deep voice while promising that Theranos would revolutionize healthcare by making blood testing faster, cheaper, and less invasive. The company raised more than $700 million from prominent investors including media mogul Rupert Murdoch, Oracle founder Larry Ellison, the Walton family, Betsy DeVos, and numerous venture capital firms, reaching a private valuation of approximately $9 billion in 2014 and making Holmes, who owned approximately 50% of the company, a paper billionaire and the youngest self-made female billionaire in America according to Forbes magazine. Theranos formed partnerships with major pharmacy chain Walgreens, which planned to install Theranos testing centers in thousands of stores, and grocery chain Safeway, which invested approximately $350 million in a partnership that included renovating stores to accommodate Theranos wellness centers. The company's board of directors included former Secretaries of State George Shultz and Henry Kissinger, former Defense Secretary James Mattis, former Secretary of Education William Perry, and other prominent figures from government and business who lent credibility to Holmes' claims despite having little relevant expertise in blood diagnostics or medical technology. The reality was that Theranos' proprietary blood analyzers, called Edison devices and later Minilab, did not work reliably and could not perform most of the hundreds of tests the company claimed, forcing Theranos to secretly run most patient samples on commercially available blood analyzers made by Siemens and other established medical device manufacturers, the very traditional machines Theranos claimed to be replacing. When Theranos did use its proprietary devices, the results were often inaccurate, giving patients false readings that could lead to incorrect medical decisions, with some patients receiving false positive results for serious conditions like HIV or false negatives that failed to detect genuine health problems. The company went to extraordinary lengths to maintain secrecy about its technology, operating in what employees called stealth mode, compartmentalizing information so that most employees knew only their small piece of the operation, requiring comprehensive non-disclosure agreements, and threatening legal action against employees who raised concerns or attempted to expose problems. Tyler Shultz, the grandson of board member George Shultz, worked at Theranos as a research engineer and became concerned about quality control problems and invalid test results, attempting to raise his concerns internally before ultimately becoming a confidential source for Wall Street Journal reporter John Carreyrou. Erica Chung, another Theranos employee, similarly witnessed quality control failures and invalid test results before leaving the company and speaking with regulators and journalists about the problems she observed. The fraud began unraveling in October 2015 when John Carreyrou published an investigation in the Wall Street Journal revealing that Theranos was using commercially available blood analyzers for most tests, rather than its proprietary technology, and that former employees questioned the accuracy and reliability of the company's devices. Holmes and Theranos responded aggressively, denying the allegations and deploying expensive lawyers including David Boies to threaten legal action against the Journal, Carreyrou, and former employees who served as sources, but subsequent articles provided additional evidence of problems, including regulatory inspection reports and statements from additional whistleblowers. The Centers for Medicare and Medicaid Services, which regulates clinical laboratories, conducted inspections of Theranos Newark, California laboratory in 2015 and 2016, finding numerous deficiencies including inadequate quality control, failure to ensure accurate and reliable test results, and problems with the validation of the company's proprietary devices. In January 2016, CMS sent Theranos a letter detailing deficiency findings and threatening sanctions, and in July 2016, CMS imposed sanctions including revoking the Newark Laboratory certification and prohibiting Holmes from owning or operating a clinical laboratory for 2 years. Theranos voided approximately 1 million test results from 2014 and 2015, acknowledging the results may have been inaccurate, a stunning admission that meant thousands of patients potentially made medical decisions based on faulty information. The company closed its clinical laboratory operations in 2016 and pivoted to trying to develop a miniaturized blood analyzer for consumer and military use, but this effort failed to produce a viable product. In March 2018, the Securities and Exchange Commission charged Holmes and Balwani with massive fraud, involving raising more than $700 million from investors through false claims about Theranos technology, business relationships, and financial performance. Holmes settled the SEC charges by agreeing to pay a $500,000 penalty, returning her remaining shares to the company, relinquishing voting control, and accepting a 10-year ban from serving as an officer or director of a public company, though she admitted no wrongdoing. Balwani refused to settle and contested the SEC charges. In June 2018, federal prosecutors indicted Holmes and Balwani on wire fraud and conspiracy charges, alleging they engaged in a multimillion-dollar scheme to defraud investors, doctors, and patients by making false claims about Theranos technology and business operations. The indictment alleged that Holmes and Balwani knew Theranos blood analyzers could not reliably perform most of the tests the company claimed, that they knew the company was using commercially available analyzers for most tests while telling investors it was using its proprietary technology, and that they made false statements about Theranos revenue, partnerships, and deployment with the U.S. military. Holmes' criminal trial began in September 2021 in San Jose, California, attracting enormous media attention as the rise and fall of the company had become a cultural phenomenon examined in books, documentaries, and a television series. During the trial, prosecutors presented evidence including Holmes' statements to investors claiming Theranos devices were being used by the military in combat situations, when in reality the military had only conducted limited tests and expressed concerns about reliability. Claims that Theranos would generate over $100 million in revenue in 2014 when actual revenue was far lower, and testimony from patients who received inaccurate test results. Holmes took the unusual step of testifying in her own defense, claiming she believed the technology worked and that she relied on advice from scientists and engineers who she believed were accurately representing the device's capabilities. Her defense team also presented evidence that Balwani, who served as Theranos president and chief operating officer, and was also Holmes' romantic partner during much of the company's operation, had psychologically and emotionally abused Holmes and controlled aspects of her behavior, Though prosecutors contested this characterization and argued Holmes was a sophisticated businessperson who made calculated decisions to deceive investors and business partners. On January 3, 2022, after 7 days of deliberation, the jury convicted Holmes on 4 counts of wire fraud and conspiracy to defraud investors, but acquitted her on 4 counts related to defrauding patients and could not reach verdicts on 3 additional counts. On November 18, 2022, Judge Edward Davila sentenced Holmes to 11 years and 3 months in federal prison, noting that she had shown a lack of remorse and that her crimes warranted substantial punishment despite arguments from her defense team that she should receive probation or home confinement. Holmes began serving her sentence at federal prison Camp Bryan in Texas in May 2023 after exhausting immediate appeals. Ramesh Balwani was tried separately in 2022 and convicted on all 12 counts of fraud and conspiracy, receiving a sentence of 12 years and 11 months in federal prison, slightly longer than Holmes' sentence. He began serving his sentence in April 2023. The Theranos scandal destroyed billions in investor value, damaged the reputations of the prominent individuals who served on the company's board or invested in the company, undermined trust in Silicon Valley's culture of fake it till you make it, where startup founders are expected to exaggerate their progress and capabilities, and raised serious questions about patient safety and regulatory oversight of clinical laboratories and medical devices. The case demonstrated how charismatic founders can raise enormous sums and attract prestigious supporters through compelling narratives, even when the underlying technology does not exist, how non-disclosure agreements and aggressive legal tactics can suppress whistleblowers and delay exposure of fraud, how traditional corporate governance mechanisms like boards of directors can fail when directors lack relevant expertise or are selected for prestige rather than their ability to provide meaningful oversight, and how regulatory agencies sometimes fail to act quickly enough to protect the public even when evidence of problems exists. For the patients who received inaccurate test results from Theranos, the consequences could have been severe if doctors made treatment decisions based on faulty data, highlighting how fraud in the medical field can directly harm people's health rather than merely causing financial losses. The Theranos case became a cautionary tale taught in business schools about the dangers of founder worship, the importance of technical due diligence, the responsibility of investors and board members to verify claims rather than accept them on faith, and the need for robust regulatory oversight in industries where failures can directly harm public health and safety. Number 2. Sam Bankman-Fried and the FTX cryptocurrency exchange collapse. Samuel Bankman-Fried built FTX into one of the world's largest cryptocurrency exchanges with a valuation of $32 billion and established himself as the acceptable face of crypto through political donations, celebrity endorsements, and pledges to donate most of his wealth to charity. But in November 2022, the exchange collapsed in a matter of days when it was revealed that billions of dollars in customer deposits had been secretly transferred to Alameda Research, Bankman-Fried's personal cryptocurrency trading firm, which used the money for risky trades, venture investments, political contributions, real estate purchases, and loans to executives. FTX operated as a cryptocurrency exchange where users could deposit dollars or cryptocurrencies and trade various digital assets, with FTX holding customer deposits in accounts that were supposed to be segregated and used only to fulfill customer withdrawal requests. Bankman-Fried founded FTX in 2019 after previously founding Alameda Research in 2017 as a cryptocurrency trading firm that attempted to profit from price discrepancies in different markets. From the beginning, FTX and Alameda were intertwined despite claims they operated independently, with Alameda receiving special privileges on the FTX platform, including a line of credit allowing it to borrow against customer deposits and exemption from liquidation protocols that applied to other traders. Bankman-Fried cultivated an image as an ethical billionaire who lived modestly, drove a Toyota Corolla, and pledged to eventually donate most of his wealth through effective altruism, a philosophy that emphasizes using evidence and reason to determine how to benefit others as much as possible. This carefully constructed image, combined with FTX's aggressive marketing including stadium naming rights, celebrity endorsements from Tom Brady and Larry David, and a Super Bowl advertisement, helped FTX attract millions of customers and billions in deposits. Bankman-Fried became politically influential through massive campaign donations, contributing approximately $40 million to Democratic candidates and causes in the 2022 election cycle and becoming one of the party's largest donors, while also making contributions to Republicans through associates. He testified before Congress on cryptocurrency regulation and was frequently quoted in media as a responsible industry leader advocating for appropriate oversight, creating an ironic situation where someone actively stealing customer funds was simultaneously positioning himself as an advocate for investor protection. The fraud was breathtakingly simple despite the complex cryptocurrency technology involved, as Bankman-Fried and his co-conspirators at FTX and Alameda Research simply transferred billions of dollars in customer deposits from FTX to Alameda and used the money for purposes having nothing to do with the customers who owned it. Gary Wang, who served as FTX's chief technology officer, created special code in FTX's systems that allowed Alameda to maintain a negative balance and borrow against customer deposits without triggering margin calls or liquidations. Caroline Ellison, who ran Alameda Research and was also Bankman-Fried's on-and-off romantic partner, used the borrowed funds to make increasingly risky cryptocurrency trades, invest in venture capital deals, and provide loans to Bankman-Fried and other executives who used the money for personal expenses, including purchasing approximately $300 million in Bahamas real estate where FTX was headquartered. Nishad Singh, FTX's director of engineering, helped facilitate the fraud by creating systems that disguised the transfer of customer funds and by using customer money to make political donations in his own name at Bankman-Fried's direction. The scheme worked as long as cryptocurrency prices were rising and FTX continued attracting new deposits, but began unraveling in May 2022 when the broader cryptocurrency market crashed, causing Alameda's portfolio to decline in value and creating a multi-billion-dollar hole in its balance sheet that ultimately came from FTX customer deposits. On November 2, 2022, cryptocurrency news site CoinDesk published an article revealing that much of Alameda Research's balance sheet consisted of FTT, FTX's own exchange token, raising questions about the circular relationship between the two companies and Alameda's financial stability. On November 6, Changpeng Zhao, the CEO of Binance, FTX's largest competitor, announced that Binance would sell its holdings of FTT tokens, causing the token's price to collapse and triggering what amounted to a bank run on FTX as customers rushed to withdraw their deposits. On November 8, FTX halted withdrawals, admitting it did not have sufficient assets to meet customer requests. Binance initially announced it would acquire FTX to rescue customers, but after conducting due diligence that revealed the extent of missing customer funds, Binance withdrew from the deal on November 9. On November 10, Bankman-Fried resigned as CEO, and on November 11, FTX filed for Chapter 11 bankruptcy protection, revealing that the company owed creditors more than $3 billion and that approximately $8 billion in customer funds could not be accounted for. John Ray III, a restructuring expert who had overseen the liquidation of Enron, was appointed as FTX's new CEO and submitted a declaration to the bankruptcy court stating he had never in his career seen such a complete failure of corporate controls and such complete absence of trustworthy financial information as existed at FTX. Ray described how FTX commingled corporate and customer funds, failed to maintain basic accounting records, allowed executives to use corporate funds to purchase personal real estate, and operated without meaningful oversight from its board of directors or accountants. Federal prosecutors in the Southern District of New York moved quickly, and on December 12, 2022, authorities arrested Bankman-Fried in the Bahamas at the request of U.S. prosecutors who charged him with wire fraud, conspiracy to commit wire fraud, securities fraud, conspiracy to commit securities fraud, and money laundering. Bankman-Fried was extradited to the United States and released on $250 million bonds secured by his parents' home, though he was later jailed in August 2023 for alleged witness tampering. Three of Bankman-Fried's closest associates, Caroline Ellison, Gary Wang, and Nishad Singh, pleaded guilty to fraud charges and agreed to cooperate with prosecutors in exchange for potentially reduced sentences. Their cooperation provided prosecutors with detailed inside information about how the fraud operated and Bankman-Fried's role in directing it. Bankman-Fried's criminal trial began in October 2023 in Manhattan Federal Court, with prosecutors presenting testimony from Ellison, Wang, and Singh, who all stated that Bankman-Fried directed them to use customer funds, knew that doing so was wrong, and worked to hide the misuse from customers, investors, and regulators. Ellison testified that Bankman-Fried directed Alameda to use FTX customer funds for investments and loan repayments, and that he knew Alameda's balance sheet was primarily FTT tokens that could not be easily sold without collapsing the token's price. Wong described creating the special code that allowed Alameda to borrow customer funds without limit. Singh testified about using customer funds for political donations at Bankman-Fried's direction. Prosecutors also presented evidence from FTX customers who lost their savings when the exchange collapsed, from investors who put money into FTX based on false representations about customer fund security, and from lenders who provided billions in loans to Alameda believing false financial statements about its assets and liabilities. Bankman-Fried testified in his own defense, claiming he did not know that Alameda was using customer funds until shortly before FTX's collapse, portraying himself as an overwhelmed chief executive who delegated financial matters to others and was unaware of critical details. His testimony was widely viewed as ineffective and at times dishonest, with the judge sustaining numerous prosecution objections when Bankman-Fried attempted to claim he did not recall specific events or conversations. On November 2, 2023, after approximately 4 hours of deliberation, the jury convicted Bankman-Fried on all 7 criminal counts. On March 28, 2024, Judge Lewis Kaplan sentenced Bankman-Fried to 25 years in federal prison, calling his testimony at trial misleading and perjurious and noting that Bankman-Fried had shown no genuine remorse for stealing billions from customers. Judge Kaplan specifically rejected the defense argument that customers would be made whole through the bankruptcy process, noting that customers' cryptocurrency holdings had appreciated significantly since FTX's collapse and that being repaid the dollar value of their deposits as of November 2022 did not make them whole for the opportunity cost of those holdings. The sentence was shorter than the 100 years Bankman-Fried could have received but longer than the 6 to 7 years his attorneys requested. Caroline Ellison was sentenced to 2 years in prison in September 2024 after Judge Kaplan noted her cooperation with prosecutors was extraordinary, but that some period of incarceration was necessary given the magnitude of the fraud. Gary Wong and Nishad Singh had not been sentenced as of 2024 but were expected to receive more lenient sentences due to their cooperation. The FTX bankruptcy proceedings revealed that customers, investors, and lenders collectively lost approximately $8 billion, though the bankruptcy estate's recovery efforts and the appreciation of seized cryptocurrency assets meant that some creditors would eventually receive significant recoveries. The FTX collapse destroyed confidence in cryptocurrency exchanges and highlighted the risks of unregulated financial platforms where customer protections that exist for traditional banks and securities firms are absent. Bankman-Fried's case demonstrated how traditional financial crimes translate to the cryptocurrency industry, as his scheme was fundamentally similar to misappropriating customer funds at a traditional brokerage firm, just executed with digital assets rather than stocks and bonds. The case also highlighted how personal charisma, political connections, and carefully cultivated public images can disguise fraud and delay accountability, as Bankman-Fried was testifying to Congress and donating millions to political campaigns even while stealing billions from customers. The speed of FTX's collapse, from the world's second-largest cryptocurrency exchange to bankruptcy in less than 2 weeks, demonstrated how quickly confidence can evaporate in financial institutions, particularly those operating with inadequate capital reserves and poor risk management. For the thousands of FTX customers who lost access to their cryptocurrency holdings, many of which appreciated substantially in value after the exchange's collapse, the fraud represented not just financial loss but also the opportunity cost of being unable to benefit from subsequent market gains that would have occurred if they had maintained control of their assets. Number 1. The Wells Fargo fake accounts scandal. Systemic fraud at America's third-largest bank. Wells Fargo, one of the largest and most established banks in the United States with roots dating to 1852, created millions of fake bank accounts and credit cards in customers' names without their knowledge or consent between 2002 and 2016 as thousands of employees, pressured by unrealistic sales quotas and an intense corporate culture that demanded selling multiple products to each customer, engaged in systematic fraud that generated fees and revenue for the bank while harming customers through unauthorized accounts, damaged credit scores, and fraudulent fees. The scandal revealed how corporate culture focused on aggressive sales targets and cross-selling metrics, combined with inadequate oversight and retaliation against employees who raised concerns, can create an environment where widespread misconduct becomes normalized and thousands of employees feel compelled to break the law to keep their jobs. Wells Fargo's business strategy emphasized cross-selling, meaning selling multiple products to each customer, with CEO John Stumpf frequently touting the bank's cross-selling success in earnings calls and investor presentations. noting that Wells Fargo's average customer had over 6 products compared to industry averages of around 3 products per customer, suggesting superior customer relationships and loyalty. The bank set aggressive sales quotas for branch employees and personal bankers, requiring them to open a certain number of new accounts each day, refer customers for credit cards and other products, and consistently increase the number of products per customer. Employees who failed to meet these quotas faced pressure from managers through daily huddles reviewing individual performance, being called out for low numbers in front of colleagues, and ultimately termination if performance remained below targets. This pressure created powerful incentives for employees to open accounts without proper customer authorization, and thousands of employees across the bank engaged in various forms of misconduct, including opening checking and savings accounts in customers' names and transferring money from legitimate accounts to the fake accounts to meet funding requirements, submitting credit card applications without customer knowledge, creating fake email addresses to enroll customers in online banking, issuing debit cards customers never requested, and setting up fake PINs using customers' birth dates or social security numbers. In many cases, employees would close these fake accounts after a short period to avoid detection, but not before the bank had counted them towards sales goals and the accounts had generated fees for the customer or affected their credit score through hard inquiries from credit card applications. The fraud was not the work of a few rogue employees, but a widespread practice occurring across thousands of branches throughout the bank's retail network, with estimates suggesting approximately 5,300 employees were fired for misconduct related to sales practices over a 5-year period. Though this represented only those who were caught and fired, not necessarily the full extent of participation in fraudulent account opening. Whistleblowers who attempted to report the fraudulent practices faced retaliation, including termination, as the bank's internal ethics hotline and compliance mechanisms failed to address systemic problems and instead often resulted in the whistleblower being identified and pushed out. Several former employees filed wrongful termination lawsuits alleging they were fired for refusing to engage in fraudulent sales practices or for reporting misconduct to management or the ethics hotline, with courts eventually finding in favor of some of these employees and awarding damages for wrongful termination. The systematic nature of the fraud and the bank's failure to stop it despite numerous internal reports and whistleblower complaints suggested that senior management either knew about the misconduct and tolerated it or created an environment where such misconduct was inevitable and then failed to implement adequate controls to detect and prevent it. The scandal became public in September 2016 when the Consumer Financial Protection Bureau, the Office of the Comptroller of the Currency, and the Los Angeles City Attorney announced a settlement with Wells Fargo requiring the bank to pay $185 million in fines and penalties and admitting that employees had opened approximately 1.5 million deposit accounts and 565,000 credit card accounts without customer authorization. The settlement sent shockwaves through the financial industry and triggered intense media coverage, congressional hearings, and public outrage that one of America's most respected banks had engaged in such systematic fraud. CEO John Stumpf initially attempted to characterize the scandal as the result of a few thousand bad employees who had been fired, arguing that the bank's fundamental sales culture was sound and that leadership had appropriately addressed the problem by terminating those responsible. This explanation satisfied no one, as critics noted that firing 5,000 employees over several years while the fraudulent practices continued suggested a systemic problem rather than isolated misconduct. Congressional hearings in September and October 2016 featured withering questioning of Stumpf by senators and representatives from both parties who accused him of failing to take responsibility, blamed low-level employees while protecting senior executives, and prioritized sales and revenue over customer interests. Senator Elizabeth Warren's questioning was particularly pointed, as she accused Stumpf of enabling fraud, called for his resignation and criminal investigation, and noted that while thousands of low-level employees were fired, senior executives who oversaw the sales culture that created incentives for fraud faced no consequences and in fact had received millions in bonuses tied to the very cross-selling metrics that encouraged fraudulent account opening. Stumpf resigned as CEO in October 2016 but received a retirement package worth approximately $134 million, though Wells Fargo later clawed back approximately $69 million in stock awards and unvested equity, and Stumpf eventually agreed to pay a $30 million fine to settle charges brought by the Office of the Comptroller of the Currency. Carrie Tolstedt, who served as head of Wells Fargo's community bank division where the fake account scandal occurred, retired in July 2016, shortly before the scandal became public, with a retirement package initially worth approximately $125 million, though the bank clawed back approximately $67 million, and she later paid a $25 million fine to settle regulatory charges and agreed to a lifetime ban from the banking industry. The scandal's scope expanded as further investigation revealed that the initial estimates of 1.5 million fake deposit accounts and 565,000 fake credit cards were significantly understated, with the bank ultimately acknowledging that approximately 3.5 million accounts may have been opened without proper customer authorization between 2002 and 2017. Additional investigations revealed other misconduct, including improperly charging customers for automobile insurance they did not need, which may have led to wrongful vehicle repossessions, and charging improper mortgage fees that may have caused some customers to wrongfully lose their homes to foreclosure. The accumulation of scandals, each revealing additional areas where the bank's practices harmed customers, created a crisis of confidence and led to the bank being placed under a Federal Reserve growth restriction in February 2018 that prohibited Wells Fargo from growing its balance sheet beyond its size at the end of 2017. An unprecedented enforcement action against a major bank that remained in effect for years and limited the bank's ability to expand its lending and investment activities. Wells Fargo set aside approximately $3 billion to cover settlements, remediation, and legal costs related to the fake account scandal and related misconduct, including payments to customers who were harmed by unauthorized accounts or improper fees. The bank made payments to millions of customers, though individual payment amounts were often small, typically under $25 for each fake account, which many victims viewed as inadequate given the stress, credit damage, and violation of trust involved in having accounts opened in their names without permission. The scandal led to congressional hearings examining whether criminal charges should be brought against Wells Fargo or individual executives, but despite calls for prosecution, no senior executives faced criminal charges related to the fake account scandal, highlighting the persistent challenge of holding individuals accountable for corporate misconduct when many people participated in creating the culture and systems that enabled fraud. In 2020, federal prosecutors charged two former senior Wells Fargo executives, Community Bank head Carrie Tolstedt and Chief Administrative Officer for Community Banking Claudia Russ Anderson, with conspiracy to commit wire fraud and bank fraud, alleging they made false statements about the success of the bank's sales model and concealed the extent of improper account openings from regulators and the public. This marked a significant step toward individual accountability for senior executives, though the charges came 4 years after the scandal became public and long after both executives had left the bank. Tolstedt's trial was delayed multiple times due to her attorneys arguing she was not competent to stand trial due to health issues, with the case remaining unresolved as of 2024. The Wells Fargo fake accounts scandal demonstrated how corporate culture emphasizing aggressive sales and growth targets without adequate controls can create pressure that leads employees to engage in misconduct, how incentive compensation systems tied to metrics that can be manipulated create opportunities and motivations for fraud, how large institutions can have widespread problems occurring across thousands of locations for years without senior management claiming to know about it, how whistleblower protection mechanisms can fail when reporting misconduct leads to retaliation rather than investigation and correction, and how accountability for corporate misconduct often falls on low-level employees who are fired while senior executives who created the culture and systems remain largely insulated from consequences. For the millions of Wells Fargo customers who had unauthorized accounts opened in their names, the scandal represented a fundamental violation of trust in their relationship with a bank they believed was acting in their interests. And for the thousands of Wells Fargo employees who were fired for either participating in fraudulent account opening or refusing to do so, the scandal highlighted how corporate pressure and job insecurity can force individuals into impossible ethical positions. The case remains a cautionary tale about the importance of ethical corporate culture, the dangers of incentive systems that reward results without asking how those results were achieved, the need for effective internal controls and whistleblower protections, and the necessity of holding senior leaders accountable when systematic misconduct occurs under their watch, as without genuine accountability at the top, the message sent throughout corporate America is that executives can profit from Cultures that encourage fraud while avoiding personal consequences by claiming ignorance of problems that were occurring at massive scale within organizations they supposedly controlled.